Hello and welcome to this week's Australian Stock Market Report. Now this week we're going to look at why Woolworths fell so heavily last week and explain why you do not need to be worried. Then we'll get into the Australian stock market so I can share with you my thoughts, where it's heading along with answering your questions and looking at stocks for you. Hello, I'm Dale Gillham, the Chief Analyst here at Wealth Within, and we're Australia's most trusted stock market educators. Now before we move on, thank you for showing your support for our channel and hitting that subscribe button. Now remember, as you subscribe, click the bell on the right of it so you keep up to date with our latest videos. Also remember to tune into our live Australian stock market show every Tuesday, 7 to 8 p.m. Australian Eastern Time. Now this is the show where you get to ask us, the stock market education and trading experts, to look at your favourite stocks and answer all of your questions. Now last Thursday, Woolworths fell over 13% on market opening and at one stage was down over 15% during the day. Now no doubt investors would have been distressed with their beloved share falling so heavily, whilst others would have been scrambling to understand what actually happened. Now the reason the share price fell was because Woolworths underwent a corporate action as it split off the alcohol and gaming side of its business into a new entity called Endeavour Group with the ASX ticker code EDV. Now the intent of the demerger is to make the supermarket simpler and more streamlined, which I believe will be good for Woolworths. However, before you get too excited and rush out to buy shares in Woolworths because they now appear cheap, you need to understand that the company is worth far less than what it was on Wednesday, given that Endeavour is now trading on its own rather than part of Woolworths, which means a significant part of the value in Woolworths, or their balance sheet, has been removed from their bottom line. While Woolworths has been a great stock for a long time, I would recommend sitting back before buying into either company to see how the market reacts to the demerger. This is because with corporate actions, it can take time for the stocks to settle, so you may be jumping the gun if you buy in, especially with Endeavour Group given the issues and regulations around gaming and alcohol. Now it's time we look at the market, and first up we take a look at what were the best and worst performing sectors last week. Now once again, the best performing sectors included information technology, and that was up 3.1%, followed by materials up 2.25% and consumer staples up 0.68%. The worst performing sectors, they included healthcare down 4.3%, followed by financials down 2.66% and energy down 2.15%. The best performers in the ASX S&P top 100 stocks included Afterpay up 12.76%, followed by Boral up 8.26% and IGO up 5.59% and South32 not far behind up 5.40%. The worst performing stocks, well, they included CSL down 6.67%, followed by Oil Search, and that was down 5.46%, and Treasury Wines Estates, well, that was down 5.21% last week. So what do I expect in the market moving forward? Well, let's get into the charts for our S&P 500 All Ordinaries Index update for this week. We'll also answer your questions and look at the stocks that you've chosen for me.
A quick reminder before the video starts. This report is an educational tool, and as such, your personal circumstances have not been considered. We hope you enjoy this week's report.
Well, I must say it was quite an interesting week last week on our market. I did expect that we'd probably still fall away a little bit further, but Friday our market came back reasonably strongly to see us do okay for last week. But let's go and have a look at the charts right now. On your screen, I've actually put a watch list of all our sectors in the stock market. Now you can see here, this is for the month. So this is what's going on for the full month. And you can see our information technology is up 16.83%. That's really driving this market at the moment, why it's not actually falling away, because it's holding it up there. But you can see down on the other end, you've got materials down 0.06% and financials down 0.033%, with healthcare up just 1.58%. These two sectors here in the red there, these are the biggest sectors on our market, and if these are going down, then the market will struggle to rise. The market's not going to continue a big bullish run just on the information technology sector. So if these stocks pull off a little bit, then we'll see the market will fall away. But you've also got here healthcare. As I said, it's another big sector on the marketplace here, but we do need to see these sectors turn around around for our market to be bullish. If these start getting more bearish, then they will drag the market with them if they do start to fall away, especially if you start seeing information technology or the money going into that pull off a little bit. I'm just going to go and have a look at a chart of the XAO, the Australian All Ordinaries Index, and you can see this is a monthly chart of the All Ordinaries Index, and you can see we've only had two small, really very, very small sort of pullbacks through this whole period since the COVID low. Not big enough for me. We do need to be doing something like about 8 to 12%, and right now we've had 1, 2, 3, 4 months since that last little pullback. It was 1, 2, 3, 4, 5 months since the previous one, and 1, 2, 3, 4, nearly 5 months through there. So we are sort of overdue for a pullback in so many different reasons. We're actually due for a pullback. Now, I know I keep saying that, and I am a bit like a broken record with regards to that, but looking at here, we are seeing this momentum is still keeping up, and it is quite surprising this momentum is so strong and staying strong for such a long period of time. Now, if I go down onto the weekly chart, we'll actually see what we're talking about here, but it has slowed the momentum. If I look at my trend lines here and I put that one up there, you can see here, if I drag it over, it's gone up there, but then it's flattened out right through this period here. So we've seen it flatten out since around about December last year. So all of this year it's been a little bit flat, a little bit more sustainable, and we have got a few little pullbacks. Now, last week we've seen 1, 2, 3, 4 weeks up to make a new all-time high through there in at 7655.9 points in mid-June there. But last week there we saw the market push down, and I'll go down to a daily chart just to show you. It really pushed down very strongly last Monday there. Tuesday bounced back pretty much what it fell almost. Wednesday, Thursday were down, and just Friday they came back a little bit. So it'll be interesting to see what actually happens, because if you can see here, we've had there's a high there, which is that 7,653, then our all-time high 7,655, then we've got 1, 2, 3, 4, 5, 6, 7 bars, and we're looking at this. We've got, out of all of these bars, it's a closed lower, closed higher, closed lower, closed higher, closed lower, closed lower, closed higher. So we've got 1, 2, 3 out of those 7 bars that closed high, and the rest of them it closed lower, suggesting it's a little bit more bearish than bullish. If we do start seeing a downward move into this week, then I would suggest it probably will go below the low of that, and if it does go below that, then we probably will be moving down into that 8 to 12% fall that I'm expecting. But again, as I keep saying, it's not really critical. It's like, to me, knowing the direction of the market is not really relevant to my trading. And I know that sounds really silly. A lot of people go, well, why don't you need to know the direction of the market? Because I don't buy the market. I buy BHP, I buy Rio, I buy Woolworths, I buy Wesfarmers, I buy stock. I actually don't buy the market, and you'll have stocks going up, like the technology stocks at the moment, whilst the market is going up. But you'll also have stocks going down while the market is going up. As you saw in terms of financials and materials. Some of those are going down, pulling those sectors down. So really it's about having stocks in your portfolio that go up and get out of the ones going down. At this point in time, you don't need to, well, you don't ever need to know the direction of the market itself. Does it help to know? Yes, it does a little bit, just because you need to know then the more sentiment in the market is more bullish or more bearish. Right now, the sentiment in the market is still quite bullish, but it's fading. And that's really where, and the big money traded on the market, and indeed most markets, comes from institutions. And so what they're doing now, if the market was going to crash, they would have been exiting a long time ago, and we'd see that. But if you see a slowing of those big stocks, it's generally a sign that the market's going to tip over and come down. And that's what we're seeing there with materials and financials. Now, the market's not tipping over. There's still money going into it, pushing it up and holding it up. So whilst it's frustrating for me to go, well, I think it should be going down, but it's not, I still don't trade thinking, I don't exit all my stocks because I think the market's going to go down. I only ever trade on confirmation, not speculation. I don't sell stocks just because I think the market's coming down. I only sell stocks when they tell me that they're coming down. I only buy them when they tell me they're going up. So people being fixated on the direction of the market will generally get their stocks wrong as well, and it's not really appropriate. You don't need to sell your stocks just because you think the market's going to fall away. You just need to have rules around the stocks. But anyway, that's my market report for this week. But we now need to get into your questions for me, which I'll do right now. The first question we have today is from Sandy, who says, "Hi Dale, what's your view on SPT for the long term, like 3 to 5 years?" So let's go and have a bit of a look at that one for Sandy. Now, what she's looking at is on the screen, Split IT Systems. talking about this is about long term is completely irrelevant right now, and really for me to do you a long term view on what this stock would do, it would take me quite a few hours of analysis and everything else, and we only have data back going to May 2019. You would need to go and look at all the research reports on it, their balance sheets, their board reports, or their annual general meetings and everything else, and look at all of that sort of stuff, and then decide too. All I can say to this stock is going down right now, and you can see it there. It's been falling very heavily since August last year. If I put my little tool on, we'll actually be able to see how far it's fallen. It's fallen so far to the close, over 70%. So right now, this thing doesn't look good. I wouldn't have my money anywhere near it. It's a small sort of stock, and I know a lot of people jumping in on it, thinking, hey, it's in that, buy now, pay later space. It's got to be an afterpay. Well, no, it doesn't. We're seeing a lot more competition coming into that space at this point in time. Whilst Afterpay's done good the last few weeks, don't naturally think that a stock like this will perform. Right now it's going down, so if you do own it, I'm not sure why you would still own it. Don't buy it now because you think it's cheap, because whilst it's going down, you don't buy stuff, otherwise you're catching a falling knife. The thing is you wait for stocks to stop falling and start to rise before you start buying it. So I don't have a long-term view on this stock, because it would be completely irrelevant to me in maybe 2 months' time or 3 months' time when more data comes out. I might change my position, and I think that's where, when you're looking at longer term, in terms of long term, 3 to 5 years and 10 years, this is where fundamental analysis really does take its hold, because you're looking at longer or forward projections from companies of where their earnings are going to be from, what their debt's going to be, and how they're going to expand their business. When you're looking more shorter term, that's when technicals that I do a lot of will really come to its strength. And I think a lot of people, when they're watching these videos, they say, Dale, how can you talk about a company when you don't understand its balance sheet? So you're not looking and you're not quoting its EPS and dividend yields and all of those statistics. I don't need to, because the charts will tell me everything I need to know for that short to medium term. They really will. Fundamentals will help me. Now, I know people out there that are just, all they do is read fundamentals and balance sheets and all the reports that come out from all the companies. And that's great if that's what you want to do. But to me, that's more medium to longer term investing rather than medium to shorter term trading. It's just a different balance. But as a trader, I still look at the fundamentals of companies, because I want to know what's good value to me. And so I'm looking for good value, because fundamentals don't tell me when. They'll only ever tell me what. Technicals will tell me when to buy and when to sell. Fundamentals just tell me what I should be buying and what I should be selling. And that's really where the technicals fine-tune everything. And hopefully that's a good understanding for most people. But thank you for asking the question. But right now I don't have any good news for you with regard to Split IT. The next question we do have is from Stephen, who says, "Hi Dale, thanks for great insights. As always, what do you think of the recent Woolworths demerger as its share price dropped significantly? As you see, do you see this as an opportunity?" So sorry, I couldn't get that one out of my mouth. Yeah, we're going to have a look at Woolworths, but we've also got another one on Woolworths, and I'll answer that one in a second. But let's bring up the Woolworths chart. Now, if you look at Woolworths chart, and you can say yes, and I will tell you that it did drop those figures, but looking at this chart, you can see this is last week on Woolworths. Now, if I open that up into a daily chart, you can see here that's Thursday where it dropped a little bit, came back up again. You're going, well, where's the big drop, Dale? Well, where the big drop is if I open this up, this has been adjusted data. So what it means here is if I go into my data here and I put where is it? Let me click on that. There we go. It didn't do that. So it'll tell me. I'm just trying to find it. I've got a little button there that has a filter for me to actually take out the actual stock split difference. So what actually happens, I won't do it right now, I'll remember to do it. Janine and I will actually be discussing Woolworths tomorrow night on the live show, so watch tomorrow night's live show and I'll show you how to do that. But basically what's happened is because prior to Thursday, there were two companies basically with Woolworths and with their alcohol and gaming business, which is, part of Dan Murphy's, is all part of all of that. So they split that off into Endeavour Group. So they split off an entity called Endeavour Group, which took part of the Woolworths business. Then there's two separate entities. So what happens with the data, what the data on my charts now is they've gone backwards from Thursday right back and taken the value of Endeavour Group out of the Woolworths share price to smooth it out on the charts. It's called adjusted adjusted data, and this is really critical. If you're a trader, you need to understand whether you're using adjusted data or you're using raw data. Raw data you can get pretty much for free because nobody adjusts it and smooths that out for you. But to looking at technical analysis, if you're using adjusted data, that means you're going to get a lot more accuracy in your trading rather than raw data. So as I said, when you looked at my chart, that big drop wasn't there, but it was there. Friday morning when I looked at the chart, it was there. It was there Thursday and Friday. But my data's now been fully adjusted to accommodate the stock split because now Endeavour is trading and I can bring up a chart of Endeavour Group. So is it an opportunity? No, it's not an opportunity. And that's really what your question was. It all is saying every Woolworths shareholder prior to Thursday, if you own one Woolworths share, you got one Endeavour share. So basically your investment hasn't changed. You've just got now two entities. So if you like Woolworths before, and you still like it now, then it's fine. It doesn't mean it's an opportunity now. Okay, if you like what Endeavour Group do, then you might want to purchase more shares in that. But again, as I said a little bit earlier in the report, I think it's really, you need to really sit and wait and see what the dust settles because, especially with Endeavour Group, not so much Woolworths, is because, as I said, alcohol and gaming has a lot of regulations. It was a bit tough. I think it's going to be really good for Woolworths, but doesn't necessarily mean it's an opportunity to buy it right now, but I do like Woolworths. The next question we have is again on Woolworths, and this one's from Aaron, and he said, and it's a bit of a slightly different question on the Woolworths demerger. He said, "Hi Dale, I'm still a newbie when it comes to investing. Love your channel and has taught me a lot. What is your thought about the recent Woolworths demerger? If I want to invest in Endeavour Group, would it be better to pay a premium price and invest while they're still together and get both Woolworths stocks and Endeavour Group stocks, or would it be better to wait until after they've demerged and then invite them, or I'm assuming, or invest into them?" You can't do that now anyway because it's all split up on Thursday. It did all of that. Now, I wouldn't have bought into Woolworths specifically because of that prior to it, really, because you just don't know how the market's going to take on that. So paying a premium for something is probably something I wouldn't actually do. But you can't do that now anyway, mate, because it actually split and the trading is two separate entities. Now, I haven't read all the documentation from Woolworths to know exactly all the fine detail points of what's going on in Woolworths because I don't own it, so therefore I don't want to waste my time reading stuff that I don't really need to read. But if you were a shareholder of Woolworths, you would have got things in the mail telling you exactly what's going on, so you don't, so you weren't panicking. But right now, it's generally with corporate action. Some of them are really good, but the majority I tend not to sort of participate in, or we tend not to participate in, because quite often it's probably a discussion for another day, but some of them just really aren't worth getting into. They just sort of make them sound great, but they're not necessarily great for people, for investors and traders. But some are good ones, and I think this one for Woolworths shareholders is quite good because you're still going to have Woolworths shares. I think it'll still do well in the coming years, but it may just be a little bit slow at this point in time. And I'm not sure right now whether Endeavour Group is a good opportunity. But thank you for asking the questions. Now, the next question we have is from Daniel. He says, "Hi Dale, weekly listener and subscriber here. Can you please look at MP1 for me? I purchased on the 2nd of June for $14.90, thinking it might slow down after passing the all-time high. Thanks for all your ongoing thoughts and insights into the market. Really appreciate it." So let's go and have a look at MP1. So he bought that early June, in the first week of June there. So let's have a look at that. So let's go right back to early June. So we would have bought in pretty much on that week there, into that sort of week there. So he's bought in there, doing really, really well. I've got no issues with this stock at this point in time, mate. I think it's a really, really good buy. You've entered it in a reasonably good place. I think there's no arguments for me of what you've actually done there. If you bought in there, I think you said 14.02, somewhere around. So I think it was 14.02. So somewhere in around there. I think it's probably a little bit early for your entry point. If you're asking me, that's not quite on 14.02, is it? Let me just see if I can move that up a bit. But you've done super, super well. Somewhere in around there. You've done super, super well, around 30% profit. I think it's looking good. It's obviously looking at slowing down. The all-time high through there is not really a reason why it's going to slow down. You've had 1, 2, 3, 4, 5, 6 weeks up. I think you'll get a bit of an easing coming back, and then it'll go back up again. But it has taken off like a rocket, so it possibly will. But if you looking at using a trend line tool, looking at the angle through here, it is running a little bit faster than that sort of angle through there. You can see there. So you'd probably find it'll start to slow down and come back to that sort of angle. So I would agree with you on that, but great pickup. So well done there. Pat yourself on the back, but make sure you've got a stop loss and an exit strategy, because if it does take off fast, it can come down and give you an exit strategy, because it may get a little bit overheated. But that's all I would suggest to you. Make sure you know how you're going to exit. Just don't exit because it's going up. Make sure it's going to tell you it's going to start to come down before you exit. The next question we have is from Detalori. Sorry if I can't say that correctly. If you could please advise if Cochlear is good to buy or an enterprise, or is the entry price too high? So is Cochlear good to buy, or is the entry price too high? So let's go and have a look at Cochlear right now and see whether it's gone a bit too high for them. Yeah, I think it's probably a little bit too high. This is a great stock. I do love Cochlear, but you've got to look at this. It's been going sideways now since 2018. So this is one of the things, if I use my horizontal line there and you go across here, it really hasn't done much since that sort of high back through there. So you're looking at a stock that's been going sideways for a couple of years. So it hasn't been this beautiful growth stock right through here. So, and again, that one there is September 2018, and we're only a few months off being September 2021, so nearly 3 years. You do have its all-time high there, even though it's did that, so that's 254.40. And it's spiked up through here, but look, me personally, right now, I wouldn't enter into this stock right now, but I'm not suggesting it's not going to go through that all-time high and keep going. I would really want it to see a higher trough through somewhere through here. I'd like to see it move up, come back down, and get a higher trough above this sort of area here before I would start to get into this stock at this point in time. But I think it's a great stock. Has long-term been one of the best stocks on our marketplace. You only have to go right back to its history. If you'd bought and held that stock, you would have made a motz of money on that. If you'd put a couple of $1,000s in that, you would have been pretty happy with it. But right now, I think it's probably a little bit too high. I want to see it's got a lot more support underneath it, given it's been going sideways for the last couple of years, or last 3 years at least. So just a little bit more careful. But if you do go into it, make sure you do set an exit strategy or stop loss underneath that. But thank you for asking the question, and thanks for all these great questions. And if you're sitting there and you're watching this video and you have any questions that you would really like me to answer, then just stick them below. But before we can help you, can I ask you to do something for us, and that's really hit that subscribe button now, because remember that here on this show where we do these Monday market reports each and every week, and we also do our live stream on Tuesday night, 7 to 8 p.m. and we really like more people to watch them, because we are helping a lot of people understand the market. And the more you hit that subscribe button, the more you're helping not only us, but you're helping everybody else, and you're helping yourself, because we're quite happy to spend the time doing these videos and helping and answering questions. It's a pretty small price to pay for you just to hit that little subscribe button now. Click the little bell on the right of it and help other people find the channel and get some enjoyment out of it and learn a lot about the market. Because the more people learn about the market, the better the market is, the more money goes into it, and the better returns that everybody gets. And so everybody wins if we do that. So again, hit the subscribe button now, click the bell on the right of it so you know when we go live with our videos. But for now, I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.